Failed banks. What are they and how many are there? There is a rating system that the FDIC has defined for rating banks. Every bank is rated by regulators according to the rating system. Generally, anybody that received TARP money, Troubled Asset Relief Program, falls in the bottom half of the rating system. In general, also, the rating system is defined by the Community Reinvestment Act of 1990, which was revised in 1998. The rating system is a four-tiered level with outstanding being the best of banks, satisfactory, passing the regulator's audits, needs to improve, a subpar rating, which causes great alarm, and substantial noncompliance, which is soon to be determined as failed. In 1998, the rating system was expanded to 5 categories in 3 areas for large banks. The FDIC still uses the 4-tier rating for smaller banks. The rating for larger banks are in the 3 categories of lending, investment, and service, and the ratings are outstanding, again being the best of banks, high satisfactory, an accomplished rating, low satisfactory, a rating that needs changes in its operation, needs to improve, significant loan portfolio change is necessary, and substantial noncompliance, troubled bank that will probably fail. When banks go into the substantial noncompliance area, they risk becoming a failed bank. A substantial noncompliance rating is garnered by having non-performing notes that exceed a certain percentage of the deposits of the bank. The bank is notified that they have a substantial noncompliance rating and a pre-receivership trust is authorized. That means that the FDIC is located on staff to assist the bank in stabilizing the operation and providing guidance for a sale to a bidder bank. Once the FDIC makes the decision to close a bank, they move into a post-receivership setup, and they negotiate with other banks a takeover strategy, wherein the new bank takes over the deposits and certain assets of the failed banks, and the FDIC receives a fee for such an arrangement. The FDIC evaluates various offers from competing banks for the failed bank prospect, taking into account the most cost-effective way of limiting the losses to the FDIC. Then the FDIC selects the takeover bank according to the lowest loss estimated by the FDIC of all the proposals submitted and secures the bank on a Friday, allowing the bank to open the following Monday under the new name. The successful bidder bank cherry picks the notes and assets it wants and agrees to a loss-sharing agreement with the FDIC on the remaining troubled assets. The FDIC estimates its losses on the transaction and agrees to pick up 80% of the losses on the transaction. The successful bidder bank agrees to pick up 20% of the losses on the transaction. That's where the TARP money comes in and actually funds the DIF, the Deposit Insurance Fund, for the unpaid principal balance of the troubled loans. The FDIC then brokers out the troubled asset to one of 5 firms: First Financial, DebtX, Mission Capital, Garnett Companies, Eastfield Secured. These firms are called loan service advisors, and their job is to prepare the troubled asset notes for resale to the private investment market. Not all of these notes that we see are from failed banks. There are troubled banks that may have a need to improve FDIC status or even a satisfactory FDIC status, but are concerned about either a change in status or a change in regulation that will cause a more severe intervention from the FDIC. Banks making these decisions list these loans as bank notes that the bank is willing to release to loan service advisory firms so that they can move up in their ratings or even just to maintain their rating. Banks pay FDIC insurance premiums based upon their ratings, and a few bad notes can result in a much higher premium on all their deposits. So it behooves a bank to rid itself of questionable notes. Why a note? What is a note? Why notes and not hard assets?